As of the close of the most recent trading session on August 4th, 2026, the U.S. stock market is currently closed, with Wolfspeed Inc. trading under the ticker symbol WOLF on the New York Stock Exchange, finishing at an official closing price of $27.06 per share. That final figure represented a massive single-day surge of 11.36%, or a gain of $2.76 per share, climbing off its previous session close of $24.30. On the surface, a double-digit jump like that signals triumph. Wall Street appears to be celebrating a massive rebound for a company that spent months dragged through the mud, fighting brutal supply delays, massive cash burn, and intense competition in the power semiconductor space. The market narrative wants you to believe that the worst is officially behind this silicon carbide pioneer, that scaling production at their flagship Mohawk Valley facility has finally turned the corner, and that electric vehicle adoption is bouncing back fast enough to bail out their balance sheet. That is the expectation. The mainstream narrative treats this recent price spike as the green light for a long-term turnaround. But if you pull back the curtain and inspect the actual capital structure, the operational margins, and the underlying debt obligations, the reality presents a far more complex and hazardous picture. While traders on retail trading platforms are rushing in to chase the momentum, institutional desks are playing a completely different game. They see a company navigating a tightrope walk where operational execution must hit absolute perfection just to service its existing liabilities. To make sense of why this stock is moving so violently, you have to look beyond the daily chart and examine the massive friction between public market perception and structural corporate realities. Look at the sheer volume moving through the order books over the past few sessions. Volume spikes exceeding 6 million shares a day indicate heavy turnover, but a significant portion of this price action is not driven by long-term value creation. Instead, it is being fueled by aggressive short covering, high-frequency algorithmic momentum strategies, and speculative options positioning. When a high beta ticker breaks through key technical moving averages, automated trading systems trigger systematic buys. Retail investors opening their Robinhood app or logging into their SoFi Invest account see green candles flashing on their screens and assume big tech funds are piling in with high confidence. They open up Robinhood stock trading or check their SoFi active investing dashboard, see the ticker climbing, and jump in out of fear of missing out. Yet institutional tracking data reveals that major funds are using these liquidity pumps to rebalance risk exposure. They understand that while short-term sentiment can push a stock up 10 or 15% in a single session, long-term share performance is anchored to fundamental earnings power. When you look across popular investing sites or monitor discussions across interactive brokers' trading channels, the focus is almost entirely on price momentum. Retail accounts using self-investing tools often miss the nuance of how convertible debt overhangs and capital expenditure requirements cap long-term upside. A single good day on the market does not suddenly erase years of negative free cash flow. To understand how we got to this exact point, we have to look closely at the mechanics of daily price volatility in the semiconductor space. Sector-wide movements have been extremely choppy. When industry heavyweights post strong guidance or when broad chip indices rally, beat-down suppliers often experience exaggerated relief rallies. Traders holding positions through an individual brokerage or managing portfolios via Fidelity Investments often see these moves as sector confirmation, but broad market lift can mask company-specific weakness. Investors using Fidelity brokerage services or trading via the Fidelity mobile app often track Fidelity ETFs to gauge overall semiconductor health, but holding an individual supplier with concentrated customer exposure carries an entirely different risk profile than holding a diversified index. What makes this situation particularly tense is the divergence between retail enthusiasm and debt market realities. If you look at the bond yields and debt pricing associated with the company, fixed income markets are pricing in substantial execution risk. equity traders are bidding up the stock based on revenue growth targets, while bondholders are focusing heavily on liquidity runways and interest coverage. This disconnect creates the exact environment where volatile price swings thrive. An unexpected update on factory yield rates or a minor shift in automotive demand can send the stock swinging 20% in either direction within 48 hours. Before evaluating the future trajectory of this company, it is essential to understand what they actually do and why their underlying technology matters. Formerly known as Cree Inc., the business rebranded to focus entirely on silicon carbide and gallium nitride technology. Unlike traditional silicon chips, silicon carbide allows electrical systems to operate at much higher voltages, temperatures, and frequencies. This makes these semiconductors essential components in electric vehicle power inverters, high-voltage fast-charging infrastructure, solar energy systems, and industrial power supplies. Because silicon carbide drastically improves energy efficiency and reduces weight, automakers initially rushed to secure long-term supply agreements. The core business model revolves around two primary segments: supplying raw silicon carbide materials, such as bare and epitaxial wafers, and manufacturing discrete power devices like Schottky diodes and MOSFETs. By controlling the process from raw crystal growth all the way to finished packaging, the goal was to capture high gross margins across the entire value chain. To achieve this, management committed billions of dollars to transition production from older 6-inch wafer platforms to state-of-the-art 8-inch fabrication facilities, anchored by their massive Mohawk Valley fabrication plant. The strategic rationale was clear: larger wafers lower per-chip manufacturing costs and boost overall output yield. However, the transition to 8-inch wafers proved far more complex and expensive than early models predicted. Growing defect-free silicon carbide crystals at scale is one of the most demanding engineering tasks in modern manufacturing. Technical bottlenecks, delayed yield ramps, and soaring equipment expenses forced the company to take on substantial debt while continuing to burn cash. At the same time, global electric vehicle adoption experienced a temporary slowdown, leading major automotive manufacturers to delay order schedules and adjust inventory levels. The combination of delayed operational efficiencies and softening short-term market demand created a severe financial squeeze, driving negative gross margins and forcing analysts to repeatedly downgrade forward earnings estimates. This operational drag directly explains why market sentiment remains so intensely divided. While retail traders using Robinhood stock trading platforms or managing self-investing accounts through SoFi Invest tend to focus on the long-term total addressable market for electric vehicles, institutional risk managers on the Interactive Brokers platform evaluate the immediate capital structure. Every quarter that cash burn remains high, the risk of equity dilution or debt restructuring increases. Those who manage wealth through Fidelity Wealth Management or build long-term holdings using intelligent portfolio structures generally require consistent positive operating cash flow before establishing major positions. I want to pause right here and ask for your direct perspective on this situation. Comment below how many shares of Wolfspeed stock you currently hold in your portfolio, or tell me if you think silicon carbide chip makers will recover before the end of the year. Your comments help drive the discussion for everyone following this ticker. Looking toward the upcoming sessions, the market is bracing for key operational updates and earnings releases. Investors analyzing options activity on the Interactive Brokers trading engine are seeing implied volatility remain elevated, signaling that market makers expect sharp post-earnings moves. The central question facing the company is whether current factory utilization rates can push gross margins back into positive territory. If management demonstrates clear progress in optimizing manufacturing yields and lowering operating overhead, short sellers could be forced into another aggressive squeeze, driving temporary upward price surges. Conversely, any operational setback or customer order cancellation could expose the stock to severe downward pressure. In a high-interest rate environment, debt-heavy technology companies face severe penalties from Wall Street if they fail to meet profitability timelines. headlines. Investors managing portfolios through Schwab Intelligent Portfolios or holding Fidelity mutual funds are watching these developments carefully, as institutional capital tends to flow towards semiconductor names with strong balance sheets and established profits, such as Nvidia stock or Apple stock. Compared to steady giants like Tesla stock, high beta supply chain plays carry much greater operational risk during macro shifts. For retail investors evaluating an online investment or considering an online investing strategy, managing risk requires strict discipline. Relying solely on momentum signals from popular Robinhood investments features or following trending lists on the Robinhood app expose accounts to sudden downside gaps. Utilizing comprehensive research from Interactive Brokers' fee schedules, checking Interactive Brokers' analytics, or seeking professional investment help ensures you're looking at the entire balance sheet rather than just daily price charts. Tools like Robinhood fractional shares, Robinhood cash management, and automated option setups make entering trades effortless, but they do not eliminate the underlying risk